The direct method is much easier to understand than the indirect method. However, you will need some inside information from the company in order to be able to truly create the direct method in its full form. The direct method actually tracks where cash came into and out of the company in a few different categories. Now, these categories change depending on the company and its operations. Some common categories would be things like cash from customers, cash to vendors, cash to employees, cash for operating expenses, cash to income taxes, cash to interest payments, things like that. It actually looks kind of like an income statement when you think about it, because it just has cash from revenue, which would be cash from customers, cash from COGS, which would be things like vendor payments and employee salaries. Now, while the direct method might be easier to understand, it's not nearly as commonly used as the indirect method. That's mostly because, as we've kind of come about to find out, the direct method's kind of hard to create unless you are actually sitting in the company and tracking these in and out cash flows. So, the indirect method you can actually create using just someone's balance sheet and income statement if you know where to look. And we're going to practice doing that along the way. So, to recap, cash flows from operations can be calculated in two different ways: indirect and direct. It's important because cash flows from operations is another way to look at profitability of a company. And it actually tells you how much cash the company used or lost in the day-to-day operations of the company. Whether you use indirect or direct does not matter, because you'll get the same number at the very end of the day. However, if you do use indirect, remember, a rise in assets is a negative cash. A rise in liabilities is positive cash. But only current assets and current liabilities are important, with the exception of depreciation, which is found on the income statement.